The stock market is sitting at all-time highs in 2025, with major indexes and top tech names posting double-digit gains after another strong earnings season. But interestingly, even at these elevated levels, members of Congress are still actively trading, both buying and in fact selling, and that includes two of the most talked about lawmakers when it comes to stock trading, Nancy Pelosi and Marjorie Greene. Now today we're going to go through a long list of recent congressional trades, and one of the biggest moves comes from Nancy Pelosi herself. And if we just take a look at her portfolio and in particular the performance, well look, over the last decade we can see her portfolio has massively outperformed the S&P, such a huge margin, 856% versus 262 of the index overall. And these are individuals who time and time again have beaten the market. In some instances we're talking a triple digit return. And whilst there's been a constant talk about banning stock trading for members of Congress, supposedly giving them 180 days to sell off their individual holdings, nothing has changed as of now. That is also when we consider that at least 78 members have violated insider trading disclosure rules, and this is typically written off as oversight, in fact sometimes clerical errors, and other times inattentive accountants. And honestly, why would they care when the fine for this violation is only $200? So let's start with Nancy Pelosi's latest move, her sale of Apple stock on October the 22nd, a company many top investors have recently been calling overvalued. And let's break down that trade and what Congress themselves have been buying and selling. And it's not just Nancy Pelosi who has sold. If we look at the last few quarters from super investors, you will see a lot of red, where in fact they have been selling quite a lot of this company. Notably, we see Warren Buffett, he's one of those that has been selling out quite significantly his position, of which, whilst it is still a number one in his portfolio, looks to be the trend from not just him but also super investors, that this is one that perhaps they are in fact starting to decrease. And if we take a look at the blue tunnel, which for new viewers highlights the intrinsic or fair price, we're seeing this company sit above even the upper end. This is where we talk about severe overvaluation, and for a company like Apple in the last 12 months, it has a few times entered into that region, although you can see potential undervaluation during Liberation Day. And if we stretch to over the last 10 years, one thing is for certain, Apple does typically trade at a very large premium overall, and interesting to see where this goes after Nancy Pelosi's sales, who does typically tend to be very spot on her buys and her selling. They did also just report their earnings, where their top line was up 8% year on year. Not great when you consider the valuation this company is trading at. Their largest growth driver, in fact, being services, which was up 15%. And on a valuation grading, they do get an F, highlighting they're trading at a 30% premium to the sector overall. They're also, as we just pointed out, trading at a premium to their 5-year average. And price to earnings growth, PEG, very important. On the channel, we typically like to see this below 2 to get us excited. It's sitting at 3.2. Not only is that above the sector, so a 78% premium, but just look at Apple's 5-year average of 2.6. You're also paying a 20% premium for a company whose growth, as we'll come to show you, does lack quite significantly. And when we look at PEG right across the market overall, lots of companies are trading well below Apple. We're talking in the Mag 7 alone. If we take a look, both Google and Meta below. Google at 1.7, Meta at 2.4. We can see Microsoft at 2.1 and Nvidia looking very attractive solely based on this metric, 1.5, which, as I'm sure you're aware, has a lot more growth potential than Apple, at least in the shorter term, and that is why they get a D on that growth grade. The revenue was up 6% last year, projected there or thereabouts this year, below the sector overall, also growing slower than their 5-year average. And if we look at the earnings per share, well, they get a D+, 10% projected over the next 3 to 5 years, massively below the sector comparative at 15, and also likewise we can see their own 5-year and our updated intrinsic value based on their latest earnings comes to a price of $184 solely based on the discounted cash flow model. Now look, the average growth of free cash flow over the last 10 years has been 8%. That is what we've gone for today in our analysis. You can see though that is the lower end where we have 8, 10, 12 respectively. As always, numbers here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Apple or any others. But straight away, look at this. On a reverse DCF now, 13.3% growth is baked in moving forwards. That is if you are buying at around all-time highs at $270. So with our growth rate and the discount rate, we get the present value of future free cash flow and terminal price. We add together with the cash, we subtract total debt, get to the equity value, divide by the shares outstanding, 184, which tells us today 32% downside. Now you may disagree and believe that Apple has a lot of growth innovation coming. Well, look at 10%, $213, still downside of 21, and even if you want to go one step further at 12, $245, negative 9%. So on all three accounts, we're talking a decrease. For it just to be flat, 13.3%. But as we want to take through our most reasonable rate, which we see as 8%, this is flagging there is no margin of safety. You're paying a 47% premium today. Now remember, on the channel, we like to use a minimum 10% MOS to really get us excited to consider buying. That would be if it met our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. That would mean a buy around $166, but today a 47% premium. Even Wall Street themselves see this at 266 into next year. That is no upside, in fact -1 downside. And again, if you want to be more optimistic, you most certainly can. At 10%, you're still in fact paying a premium of 27, and for those that believe the upper end of 12, well, still a 10% premium. Let us know though if you believe this was the right move by Nancy Pelosi. And before we do jump into the rest of stocks that members of Congress have been both buying and selling, we want to let you know we are releasing our latest free weekly article tomorrow morning, as we do every single week, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where later today we are releasing our spreadsheet of stocks that look severely undervalued for the month of November. Make sure you're subscribed, we will be getting that to your inbox in a few hours. Lots of information for each one as well, the upside too that Wall Street themselves see over the next year. And if you sign up now, you can grab straight away a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We're now going to jump into 4 stocks that members of Congress have in fact been buying before ending with the 2 stocks they're selling. Number 1 is Microsoft, which is up 27% over the last year. Year to date up 23, over the last 10, massive outperformance of the S&P. They are trading towards the upper end of the 52-week range, just under a 10% pullback, where we get a strong buy rating from Wall Street, very high, 4.78 out of 5. Seeking Alpha, a 4 out of 5, and it is trading at a forward P of 31, just slightly below their historical average at 32, which when we do take a look at the blue tunnel, it is sitting around the midpoint, which again does confirm reasonable valuation. Only during Liberation Day in the last year was Microsoft trading undervalued. And when we do zoom out to the last 10 years, Microsoft, very similar to Apple, is one company that very rarely, if at all, trades below the bottom line at a severely undervalued signal. So maybe this is one to have at a bare minimum on the radar if you do like the company. And they just days ago released their quarterly earnings. Top line was up 18% year on year. Probably very impressive to see the continuation in strong growth in the cloud, which was up 28%, And whilst we like to see efficiencies, operating profit up 2 percentage points year on year, bottom line did come in at a decrease of 2 percentage points. And their valuation, it does get an F. Bear in mind they're trading at a 28% premium to the sector, but within the sector, a lot of low quality companies, Microsoft would be in as one of the top quality ones, therefore making this a little bit redundant. Against their 5-year average, though, we did say just slightly below. Price to earnings growth, as we've said, one of our favorite ones to compare, 2.4, yes, expected a premium to the sector, but actually now on a PG is trading the same as the last 5 years. Definitely something that does get us a little bit excited, more so if it does come closer to 2. And our updated valuation comes to $502. Now we've used a growth rate of 16%, which is slightly above the average of 14. You will note baked in today is 16.6, and using that middle rate of 16%, there isn't a margin of safety. We didn't get one from Apple either, but what you notice here is trading at a very small premium. We're talking 3%. Now look, if you want this at a 10% MOS, a buy at 452, at 20% 402, and 25 at $377. Now Wall Street themselves see this at $633 into next year. We're talking 22% upside, so maybe one to actually consider. Will be interesting to hear your thoughts on this. But if we just pull it back to essentially their 10-year average, you will notice 437 downside of 15%, which equates to 18% in terms of a premium. Likewise, and for completeness, at the higher end of 18%, you may believe that is in fact more appropriate, still comes below what Wall Street anticipate into next year, does give you an 11% margin of safety. So let us know on this stock that members of Congress are piling into. The next stock they've been adding is in fact Netflix, which just recently announced a 10-for-1 forward stock split. But whilst it hasn't done that, we'll just look at the current trading price, where it's up 48% in the last year, year to date up 26%. Over the last 10, another massive outperformer, trading around the midpoint of the 52-week range, pullback from 52-week highs and all-time highs at $1,341, where Wall Street are the only ones with a buy at 4.1 out of 5. Likewise, they also released their earnings a couple of weeks ago, top line up 17% year on year, largest driver coming from Asia Pacific up 21%, although we don't like to see decreases in terms of deficiencies to every single margin, and a D- on the valuation grade, 207% premium to the sector, 9.5% premium to their 5-year. But PEG looking good, it is below 2 at 1.8. Yes, expected premium to the sector, but interesting to see historically this company's PEG was lower, meaning a 23% premium. And our intrinsic price comes to $832. Now bear in mind, we are using a growth rate of 15%. Most recent year, free cash flow did stay flat. We can see on a reverse DCF, 19.7. You may look at that and say pretty high. In fact, whether you use 10, 15 or 20, we're talking downside or pretty much fair value. You need to see this at what we've classed as the extreme 25% to really get an undervaluation signal, which equates to 36% upside. So using our 15% growth rate for Netflix, we're talking about a 35% premium. Wall Street very bullish, Congress also seeing 27% upside, 1420 into next year. And if we do go one step higher at the 20% level, in fact we do see it pretty much around its fair price. Let us know your views, whether you see this as a buy, hold or maybe sell. And for those that believe they want to see or in fact agree extreme is very, very reasonable, at 25% does put it nearer than the others at that Wall Street forecast. You're talking about a 27% margin of safety. So on Netflix, give us your views. The next stock they've been loading up, one that we've covered quite a lot, and actually we believed back when we looked at it, it was undervalued, MercadoLibre, up 14% over the last year, 37 year to date. Over the last 10, very strong, up 1,860%, trading still around the mid to upper end of the 52-week range, 52-week high coming in at $2,645. A strong buy from Wall Street, a respectable buy from Seeking Alpha, where they did get a miss in their earnings not that long ago, projected a decrease in the next quarter, but the subsequent 3 strong double-digit growth, with expectation based on 2026 numbers, the forward P sitting around 36.4, and a D- on the grading if you want to look at a P basis, 240% premium to the sector, big discount to their 5-year, but PG looking very good, 1.74, slight premium of 6% to the sector's 1.65, and our intrinsic price at $3,268 is using a growth rate of 6%. Just look at the last 2 years, and in fact in 2022, very large increases to the free cash flow, and on a reverse DCF, 1.4% may already give it away that this one still looks severely undervalued. Using a 6% growth rate where we're covering a 29% margin of safety. Wall Street themselves, alongside members of Congress, do love this. Upside projected 27%, $2,950 into next year. And if you wanted to be incredibly conservative at only 2% for a very strong growth stock, you're still getting a margin of safety sitting around 4. Let us know though your views on Melly today. And then the final buy today, Uber Technologies up 34% over the last year, 60% year to date, up 177 over the last 5, trading very near to all-time highs above $101. Triple buy across the board, Wall Street and Quant very close to both of them flipping into the strong buy rating, where their latest quarter top line was up 18% year on year, as well as trips and monthly active users, all of these showing some real good strength. Uber Eats delivery in particular up 25% with nice 4 percentage point increase to their operating profit margin. And if you do look at a lot of their valuation metrics, they are trading at historic lows and they're grading at a C+. We can see 27% premium to the sector overall, 26% discount to their 5-year average. Another one looking exciting, a PG on a forward basis at 1, which is well below the sector at 1.9, a 47% discount. And we have the intrinsic price at $146. Now this is using a growth rate of 15%. Baked in today is 9.3. Whether you use 10, 15 or 20, each one upside. In fact 20, we're talking a double from today. And on the middle rate of 15%, you are getting allocated a 34% margin of safety. Wall Street themselves see 120 into next year, 24% upside, and if you want to be conservative and use the lower rate of 10% today, you're still getting an MOS sitting at 5. Wall Street like this one a lot. We also saw a member of Congress adding Uber Technologies, in your views, is it a buy, hold, or complete avoid? We then move to the two stocks that they are continuing to sell. Number one being Alphabet, up 64% in the last year, 49 year to date. Over the last 10, 638, trading very close to all-time highs that we saw last week, $292. Strong buy from Wall Street, although pretty much on the cusp at 4.5. Respectable buy from Seeking Alpha, where we notice is trading at a forward P of 27, well above the 5-year at 22, also well above the lows we saw in this year alone around the 15 to 16 mark. And we also get that overvaluation signal looking at the blue tunnel, something we've only seen for a few weeks in 2025. In fact, during this year, long period, severe undervaluation. If you were subscribed, you would have known this from many videos. We covered this, calling it a strong buy. And zooming out to the last 10 years, one thing we would say, if you do want to allocate this to your portfolio, just wait. Yes, you can't listen to history, it doesn't repeat itself, but when we do look back, this is a company that more often than not does trade at a discount overall, so the chance is very likely we will see this in the short to medium term come back to undervaluation. And their latest quarter was very strong, top line up 16%, their dying search business, according to analysts, up 15%, YouTube likewise strong growth, their cloud extremely impressive, up 34% year on year. We got efficiency to their gross margin as well as their bottom line up 4 percentage points. Operating note slightly down at 2. Where on a grading of valuation they get an F, 89% premium to the sector, 15 to their 5-year that we just highlighted. PEG, yes, looks good at 1.9, but what we would say is historically it's been a lot lower at 1.35, meaning you're paying a 43% premium. And our updated valuation comes to $229. Now we've used a growth rate of 12% moving forwards. You will see baked in today is 15, which is actually above the higher end. So if you use low, medium or high, each one is downside with respect to the current price. If you wanted the extreme at 16%, you would see upside, but very minimal, meaning there isn't a lot in terms of the risk to reward ratio. But using the middle rate at 12%, you can see you are paying a 23% premium. Wall Street, yes, strong buy, but only see 9% upside into next year, $306. Maybe this is one to hold, or like members of Congress, you are considering selling, and will just flag even if you do use the 16% extreme rate, which does put it around what Wall Street see into next year. Margin of safety is fairly minimal at 7%, but do let us know your thoughts. Another one they've been selling is Taiwan Semiconductors, up 58% in the last year, 52 year to date, over 1,200% in the last 10, trading very near to its all-time highs. Double buy, interesting. Wall Street very close to a strong buy rating. It wasn't that long ago on this channel we covered this, significantly lower than the current price, where we did see triple strong buy across the board, and we're seeing the forward P25 above the 5-year of 22. And when we look at the blue tunnel, we can see this one very recently has been trading overvalued. Again, in the last year, like many companies, if you do follow them, you can buy them at the right price. They do tend to trade both overvalued and undervalued in a single period. And zooming out to the last 10 years, this is also confirmation. Periods in fact, where it's traded at a premium, likewise at a discount, and also in a reasonable value. Now their most recent quarter, very strong, top line up 41% year on year, efficiencies right across every single metric, and their valuation grading D-, 15% premium to the sector, 29% premium to their 5-year. PG though does look good, 1.14, even with the growth the share price has seen, trading at a 36% discount to the sector. And our intrinsic value comes to $297, the average of the 4 models, which as always, you can grab a copy by clicking on the pinned comment below. However, if you solely want to look at a DCF, you will notice 21% is baked in on a reverse basis, very high, where we're looking at 15% moving forwards. On each occasion, we are looking at downside. So using all 4 at 297, we actually believe this one is trading roughly around its fair price. Wall Street themselves see 341 into next year, 14% upside, and at a 10% MOS, a buy at 268, at 20, a buy at 238, and 25, 223. So let us know your views on what members of Congress have been doing, as well as Nancy Pelosi. And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.